Good afternoon, everyone, and thank you for joining us. We are just having a few minor technical difficulties, which, if you've attended these things before, is not super unusual. But apologies, the internet is playing up a little bit on either Tam or mine end, so there may be a bit of delay. We'll try and manage that, but we'll see how we go. Welcome to all those who've joined us before, to the new people as well that have come along for the first time. Great to have you along. We think this presentation we put together today is going to be useful for really anyone in business to really get their head around what tax is, why it's there, and maybe how to remove it. And as the title suggests, hopefully never have to worry about it again, because that's a big part of what we do, is making sure that people can run their businesses and do what they do really well without having to worry about that big tax bill sneaking up and smacking you in the back of the head. So we're going to go through that today, and we'll be here for probably about an hour. Presentation will be about 45 minutes, and we'll have some time for some questions at the end. Please feel free, as we say, all the way through, just so you don't forget your questions. If you have a question that comes up, please feel free to add it in the chat. We'll answer it at the end. All right. So if you haven't been with us before, my name's Joe. This is Tam. We operate in the advisory section of PTP. So we're all about helping businesses get more out of themselves and their businesses in terms of their profit and their cash flow, flexibility, growth, all that sort of stuff, all the exciting things. But today we're talking about the not so exciting topic of tax. So where are we now? I think it's fair to say that the general economic conditions across the world, particularly in Australia, are uncertain. Interest rate rises, fuel costs going up, all the other stuff that goes along with that, really impacting a lot of businesses and people generally, and will continue to do so probably for a little bit of time. So there's a lot of indecision, a lot of uncertainty in the general economy and in our client base and the people we talk to right now. So costs are up, margins are being squeezed, there's cash flow pressures, all that sort of stuff. So we fully understand that that's where a lot of people are in this space. And the last thing we want to add in addition to that is a tax bill. So where are we within the year as well? So that's the general economy. Where are we within 2026? Obviously coming into autumn, winter, which for a lot of businesses means a little bit of a slowdown, not for every business, but for a lot of businesses in hospitality, retail, all those sort of things. Autumn, winter can generally be a slower period of time. So we acknowledge that. And we're obviously coming into the end of financial year as well, where last day of the March quarter, we have effectively 90 days left of the financial year, which is a bit scary when you say it like that. But 2025 tax has hopefully been completed or close to being completed, and we're now starting to plan for year end in 2026. All right, Tam, I might hand over to you.
Sounds good. Sorry about the lag, guys, if there is a lag between Joe and I, but the common approach. So we quite often hear clients that say, I have a profit, how do I get rid of any tax? Where can I spend money to reduce tax? I don't have the cash to pay for the tax, and I don't want to pay any tax. These are really common, I suppose, questions and statements from clients that we see particularly more at this time of year and when we're doing their last year's tax, so the 2025 tax compliance.
Well, looks like we've lost Tam there, so I'll continue on with this. That's okay. And she can jump on when she's back. But just a couple of things to have a bit of a think through here, and probably a few statements that are might be a little bit jarring for people. But I suppose just to change how we look at what we're doing here, and how we approach tax, because a lot of getting our head around tax is understanding why it's there, that it will be there, and then managing that, rather than trying to fight it. So when we try and fight against anything, it can be turns into a battle as opposed to allowing it to flow, minimize it, and deal with it as we go through. So first one there, if your business is profitable, tax isn't optional, it's inevitable. So I know you've probably spoken to a mate, make sure he doesn't pay any tax. If he's making a profit or a business is making a profit, it will pay tax at some stage. That is inevitable. It will be the case. There's no avoiding that. So just be mindful of that. The goal isn't to avoid tax. It's to build enough profit that tax isn't a problem. So that's more hitting on the fact that that we've only got so much energy and ability to prioritize within our business. And if we steer that direction, if we steer that energy and prioritization towards tax, our ability to grow and grow profit in the business as well. A zero tax mindset often does more damage than the tax itself, because if you've got a zero tax mindset, then even $1 of tax is going to be too much. So again, not the reality of the situation. And again, we're not going to make any comments about political stuff and governments. We know tax, no matter what government is in, we know tax is going to be a reality in our economy. So most tax stress doesn't come from how much you pay; it comes from not planning for it. Again, it's quite often the one that sneaks up on you that you don't see coming that hurts, not the fact that the amount is there. A lot of people understand you need to pay tax and why we pay tax, but it's the unexpected ones, and when you've already spent that money, as we're going to touch on, where that can really do some damage. Spending money to save tax is still spending money. So we're going to touch on that a little bit later on, that whole concept of spending $1 to save 30 cents. I don't know, I'd much rather have the dollar, pay 30 cents and keep 70. So unless it's a useful thing that we were going to buy anyway, perhaps keeping that money and just paying a little bit of tax might be the way forward. Again, we're looking at overall wealth creation here. We're not looking at tax minimization. And I think that's another thing to have a think about here, is if we think about the bigger picture and what our overall wealth looks like, because that's the important thing, as opposed to the short-term focus of nil tax or minimize tax, then we're in a position where we can look at a lot more options. Tam, we've got you back there. How's your speed? Is it working okay?
Hopefully that's a little bit better. Maybe not.
Okay, we'll see how we go. So we've gone through that slide. See how you go. Profit versus cash.
Beautiful. So the cash in your bank is rarely going to reflect what profit you've made for the year. And the reason for that is that a profit is based on income and expenses, income less expenses. And there's things in your balance sheet items where your money then goes after your profit less expenses. So things like loan repayment, drawings, your income not being collected from people who owe your money, so accounts receivable or debtors, and potentially you've purchased some assets with cash. So quite easily you can have a large profit and very little cash in the bank. And there's this disconnect between what you're making on your tax return for your profit or your financials, and physically what's in the bank at the end of the year. So an example for that would be the cash.
Keep in mind that the tax is based on profit, not on cash in the bank. Correct. Sorry, Tab. Correct. I was going to say tax is based on profit, not on what cash is in the bank.
Yeah, absolutely. So a bit of an example here. John has shown a profit of $100,000 for the year for the end of June 2025. And he has $20,000 in the bank, but he's just received a tax payable for $25,000, which is 25% of his $100,000 profit. So he doesn't have enough cash to cover it. How can that be? He had 20 grand of debtors that have not yet been collected. He spent 30,000 on a forklift out of his cash. He'd taken 30 grand of drawings out of the business and only has 20 grand of that $100,000 left. So in a bit of a panic stations for John, and we're going to come back to him at the end to kind of hone in on why some of the things we're going to talk about today is quite important. Beautiful. So why does tax feel unfair? And that's just because that, coming back to what we were just talking about with the cash flow, tax is based on profit, not what you have in the bank. And quite often the cash is often already spent or used elsewhere because of the timing. So if you're paying tax a long time after it's been incurred, so, think 30th of June last year was 9 months ago. It was incurred in that financial year leading up to then. And quite often you have until May this year to pay for it. So it's almost well over 12 months from when you've incurred some of this tax. Now, when you look at your BASs, quite often they're 4 months after you collect the GST and pay your wages and rack up that PAYG component. And income tax, there's that even longer lag. So that's why it feels really unfair, because if you're unaware of what's coming, it's a really long time after the fact that you've earned it, and quite often the money's disappeared. So what do we see with the June trap, Joe?
So quite often people get to the end of the year, they get to not even now, probably to June, and they say, okay, I've got, look at their profit and loss on their Xero or on their MYOB or whatever they use, and they say, well, I've got to, let's use that example before with John, I've got $100,000 profit, and I don't want to be paying tax because I know if I've got a profit, I'm probably going to pay some tax, even if I haven't got any cash necessarily. And so what they do is they rush out and think, well, what should I go and buy? So how can I reduce my tax now? So we end up with phone calls from clients quite often, or potential clients saying, well, can I go and buy some stock? Should I go and buy a new car? Should I prepay some expenses? What should I do in order to reduce the tax? In effect, asking how much money should I spend in order to reduce this tax down? And it often leads to rush decisions because we get to June and you've only got 30 days at most left. You've got to go and make those decisions, and it leads to a situation where you use a lot of the cash that's in the bank, or you commit to a loan potentially if you go and buy a bit of equipment, and it can cause a real headache down the track. So what we talk about with clients is that tax planning at this time of the year, and we always do it between April and May, so that we're not getting stuck in that June trap. Tax planning should confirm your strategy. And what we're talking about tax planning is reviewing it now, should confirm your strategy, not determine it. So you should already know now how much tax you're probably going to pay this year, and ideally have that put aside or have a plan as to how you're going to reduce that down, or have already done the plan to reduce it down. And we've thought about it all through the year, as opposed to right at the end and only in this year. So what do we know that doesn't work? What doesn't work, and this sort of carries on from that June trap, is that we spend cash to save tax. And I touched on this before. We spend $1 to save 25 cents or 30 cents. So, effectively we're spending the difference between the two. We're out of pocket in that case, 75 cents. And yes, we've saved a bit of tax, but did we need the thing that we needed to spend 75, that we spent the dollar on? Or could we have just kept the dollar and paid the 25? So you're saving tax, but you're losing more cash doing that, or potentially borrowing money, buying assets or prepaying unnecessarily. Often you don't get a full tax deduction if you buy a car or something like that. Prior years you have, and that's been a different matter. But quite often now you buy a bit of equipment with cash, you don't get a full deduction. You either have a lot less cash in the bank, or you had to take out a loan, which means you've got to pay repayments for the next number of years, and it creates future cash flow strain, either because you have less cash or you've got to make those loan repayments. Holding back on invoicing is something we see as well. So it creates an artificial result. So people just won't invoice until, say, 1st of July or later on in July or something like that. It hurts cash flow and clarity, particularly at the moment. People aren't going to pay bills until they need to. Now, if you bill them on the 1st of July as opposed to 30th of June or at the end of June, that can make a tangible difference as to when you're paid. So cash flow being the major driver cash flow should be the major driver as to what decisions you make here, and then we look at the tax implications secondary to that. Another one is I touched on before about the assets, but prepaying unnecessarily. If you think about what you're doing, I use the term a lot, kicking the can down the road when we talk about this sort of thing with clients, because if you buy $20,000 worth of stuff that you're going to need next year anyway, it means you're either got to continue to do that year on year in order to stay at that same level, or you're going to need to pay $20,000 less of that, of whatever that thing was next year. So you've effectively moved your profit from this year into next year, or you've moved that deduction backwards. So is that actually worthwhile? It might be, but it doesn't necessarily always mean that's the case. We're going to touch on how we look at tax planning a little bit differently a bit later on. All right. So good businesses pay tax. Sorry, Tam. You go. You're right.
No. You're fine, Joe. Sorry, guys. I think I'm really delayed here. So good businesses pay tax. Great businesses plan for it. So what we want you to understand is that all businesses, if you're making a profit, you're going to pay tax. So it's not about trying to not pay any tax. It's about planning for it and be really clear and visible on what that looks like. So how do we change how we think about tax? So the goal isn't to worry less about tax, but it's rather to understand your numbers so that it stops being a surprise. So I want you to move from what Joe was talking about before, what doesn't work, spending the cash, adding expenses, and all of that, to maximizing profit and managing tax. So tax is inevitable for any profitable business, and a large part of this is just accepting that that's the case. Doesn't mean that we shouldn't minimize it at all, because no one likes paying what, if you can avoid some of it. So you don't want to minimize, it doesn't mean that you shouldn't minimize your tax bill, but it simply means that we want to use all of your energy to grow your profit and understand what tax is coming all the way through the trade and be putting that aside. So what does work? So we've gone through what doesn't work. What does work? So understanding, so knowing where your numbers are and what is your profit, what's your cash at the bank, and what is that tax position being like at any one point in time throughout the year. Planning, forecast for both profit, knowing what your profit is, but also what that looks like for tax, so that you can remove any surprises that are coming. So implement things like structures such as buckets, which we're going to tack on or go through in a minute, and timing. So understand the timing of these things and review. So ongoingly review all the time, not just once a year, each month, each quarter, understand where you're at. So Joe, I'll get you to go through the bucket system.
All right. I'm sure people are sick of hearing us talking about this, but it is the most powerful thing you can do in your business to get a hold of exactly where you're at with your tax and make sure it's not a problem in the future. And people that don't do this are the ones that quite often find themselves in a position where they just don't have the money available, and they find themselves in a position far behind where they thought they were going to be. So you're acting as a bank for the ATO, effectively, a lot of the time, particularly with GST and withholding tax, because it was never your money to begin with. So what we talk about is take that cash out of your operating accounts. So if you're making decisions and using money that is not yours, because you're going to have to pay it later on, that's not optional. It's going to be there. Then you're going to run into problems when it falls due if you're not aware that it's there. And the reality is that if you don't take it out, most clients, again, in our experience, will tell us that if they don't do it, they generally miss it somewhere, because there's so many different types of tax, and the timing is so irregular with income tax and BASs and withholding, like in PRYG installments and all the different types of stuff. So it's very hard to stay on top of it unless it's out. So 99% of issues in the tax space come from spending money that was never yours to begin with. So what we suggest is setting up an account to transfer funds for GST, PRYG withholding. So that's the amount on the wages that you pay to bring it up to the gross amount. So when you pay your wages each week or fortnight or month, however regularly you pay, you only pay the net amount, and that's not quite often forgotten about. The additional amount to take it up to the full amount needs to be paid to the gross amount, needs to be paid to the ATO at some point in the future. Generally speaking, that's either monthly at the end of each month, or quarterly with your BAS and your GST. But again, that's not negotiable. It has to be paid. Superannuation, keeping in mind that payday superannuation is coming up, which will mean that that will need to be paid on payday, as the name suggests. And that should remove a lot of that cash flow strife there, in that you won't be able to accrue a big liability there. It'll have to be paid on the way through, which is a good thing. And income tax, this is the big one. This is the one that really catches people. I think most people can get their head around the GST and the fact that you're effectively capturing that and then giving it back to the government and claiming some GST credits on the way through, and the withholding. The income tax is a big one and the painful one, because as Tim said before, it's quite often 11, 12 months later. So you can imagine if your biggest creditor or your biggest supplier didn't bill you for 12 months, and then all of a sudden said, okay, well, here's the last 12 months worth of bills that you should have paid us. As well as that, we're going to make sure that in order for us to get paid for the next 12 months, we're going to make sure you pay us in advance on the way through as well. So not only do you get a nice big bill for what we didn't bill you for last year on the way through, you also get to pay this year as you go through as well. So effectively, you have 2 years lumped into the one. And if that happened, that would cause a major cash flow issue, most likely in most businesses, I would say. And if that's the case, then unless you've got the cash aside or you've got it saved or available, you're going to be in a fair bit of strife. That's exactly what the ATO do with income tax. They're not a supplier to you, they're a taxer, but that's what the impact is that if you haven't put that money aside and you're not aware of it, because it's not appearing in your creditors, it's not appearing anywhere, and we haven't thought about it, then you're going to get caught. Okay, so income tax, budgeting and installments. So it's the least visible and hardest to manage, income tax, because unlike BASs, it doesn't pop up every quarter quite often, particularly when you're new to business or you're coming out of maybe a loss position or a no tax position. It's timing. It's often a long way after the end of the financial year where you receive a tax bill. Even if you lodge a tax return straight after, it's often not due until much later. The payment and the method of collection, there's two types of that. And this can be confusing as well. So lump sum, this is referring to the example before, the $100,000 profit that John made. He gets a tax bill for $25,000 at the end of the year. That's a lump sum payment at $25,000. He's got to find that and pay that to the ATO by the due date. Then the installments as well. So the installments are for tax in the future. And income tax in the future, and it's calculated based on the one you've just paid. So what can happen is, and we just said there, you often get them both at once, because what can happen is if your business is growing and your profit is growing, well, obviously your tax is going to grow over that period of time as well. So you may pay installments all through the year and still have a lump sum to pay at the end. Alternatively, you might have a bit of a downward slide or a leveling off of your profit. And it may well be that you don't have a lump sum to pay, or you may get a refund. And again, it's about managing it and making sure we're keeping that as flat as possible. We don't want big peaks and troughs with our tax. We don't want big refunds followed by big payables. And it's because you can't manage that. You can't plan for that. Okay, I think we've lost Tam for the time being. So Tam, when Tam gets back on, we'll continue with her being involved. So case study, again, coming back to John. So John starts a business, and just bear with us with the dates here, in July 2024. So he operates for 12 months and he generates a profit of $100,000 for the year ended 30th of June 2025. So he's made $100,000. His accountant lodges his tax return for 30th of June 25 on the 15th of November. So what's that? Probably about 5.5 months after the end of the financial year, and calculates his tax to be $25,000 for that year. That amount is due for payment in May of 2026. So again, it's not due. He's calculated it in November. John doesn't have to pay that amount until a full 6 months later. We've got Tam back. Okay. The ATO recognised that John will likely have a tax bill for the following income year, 2026, because he's had one for 2025. So, if he continues along as normal, or as he did in that year, he'll probably have a tax bill, and adds him to the instalment system from the December 2025 quarter onwards. Now, the reason, and I suppose the connection there of December 2025 is because he's lodged in November. So they've worked out, okay, yep, he had a tax bill last year. He's probably going to have one next year. So we're going to put you on the instalment system, and that will start in that year. So they assume his results going to be similar to 2025, and they add a little bit more as well. So the estimated tax is 25, and they probably look at it and say, okay, 3 quarters, December, March, and June. So we add a bit on because he might increase his profit a little bit, or with CPI and that sort of thing. And they set an instalment of $9,000 for each of those quarters. Right. So by the time he gets to paying those 3 instalments at the end of June 2026 year, he's paid, in theory, $27,000 in advance, and he's got enough to cover his tax bill. So he's got the dollars there, and he's got the credit. Now that's what happens as far as the administration from the ATO. The payment of it and the understanding of that can be very different. You may have already picked that up from the sheer size of the numbers here. They're big numbers. So generally speaking, we see 2 things here, 2 ends of the spectrum. And Tam, I might give you a crack of, do you want to run through the scenarios and see how that's going?
Definitely. Sorry, guys. So John with no plan. So John hasn't reviewed his numbers or saved any money during that first year of operation. So what happens next? As Joe said, November his tax is lodged. Tax bill for $25,000 is a complete shock to John. And then, as Joe said before, that December BAS comes around and the ATO installments begin in January. So the crunch is really between January and June 26, where he's got 18 grand of installments across that December one that's due in January and the March one that's due in April. He's also got that 25 grand tax bill. So in 6 months, on top of all his other outgoings, he has $43,000 that he needs to find to pay to the tax office. So how does John feel? He feels like all he's doing is paying tax, and that he's already well behind the 8 ball, and how is he ever going to catch up? And that's a really common thing that we see with lots of people. But on the flip side of that, scenario 2 is John with a plan. So John has tracked his numbers monthly, knows what his tax position is, and has set aside 30% of his income in a separate savings account as he's gone. So that separate bucket that Joe was talking about earlier, he's put money aside in there and he hasn't touched it because it's not his money. So what happens now? He's got the profit of 100,000, has tax of 25, but that money's aside. He's expecting his installments, and there's no surprises. His cash position, that tax bill's already funded. So he already had $30,000 because he was putting aside 30%. So we had, at the end of June, he already had 30,000. Plus he started continuing putting aside 30,000 into the current year. So he's got, not only does he have that tax aside, he's also got money aside for the installments for the current year as well. So he's created that really good ongoing habit. Now, how does John feel? He knew it was coming and he's already got it covered. Now, pain doesn't come from the tax, it comes from the timing and the lack of control. Now, something that Joe and I were talking about, one of my clients, he's paying more tax now than what he was back when we started. Now, when he started, he had no visibility on his tax. He felt like he was a hamster on a wheel that just continually was paying tax. What money was coming in was going out, and he wasn't saving anything. He wasn't building wealth, and he felt like he was getting nowhere, and he just thought that was being a business. Fast forward 4 years, and he said to me the other day, I'm paying more tax now, but it feels better because I know what's coming. And I think that's a really powerful place to be in as any business owner. So it's not the fact that he didn't like paying tax. It's the fact that he just had no control or visibility around that huge, big cash flow burden. So strategic tax planning. So quality tax planning is about flattening and smoothing out those highs and lows, achieving the best average tax rate possible, and utilizing strategies that maximize your wealth and minimize the tax. So Joe and I like to look at a 3-year window. So we look at last year, what is coming forward into the current year, and what impact does the past year have? What's happening right now in the current year? So what are our immediate tax payments, and what strategies do we need to implement now? And then looking forward into next year. So do we have an unusually good year in the current year that we need to be, looking at changing the timing of some things to even it out? So if you only look at the current year that you're in, you're limiting that ability to be able to foresee and impact, things that could be happening in that medium to long term that could help impact that overall wealth of yours. Do you want to add anything there, Joe?
No, I think just in addition to your story with your client, I was probably one on the other way. I had a client that I was talking to a little while ago that probably went the other way and took too much money out of their business, drew it out and used it well, paid down some debt, which was really great. But they'd gone too hard in a short period of time. And by the time we caught up, not long after that, it was more of a case of, okay, that's great, we paid down some debt, but we probably haven't allowed enough for the tax that's come with that. So we've got to pull some of that back out and put it back into the savings so we know it's there. So we don't forget about it at the end of the year. And again, it's that psychological pain of they've already banked that win, right? So they've already reduced the debt. They've had a win. That surprise of the tax bill coming, even if it's within the year and it's more reserving, it's a really painful thing to find that money later on after you've already banked that win and put on. So that's where we're saying it is largely about staying in front of it and knowing what's coming and what's going to be in front of you. And exactly what Tam's talking about here, the way we do it at PTP with our strategic tax planning is making sure that we're looking at the whole picture, not just how do we save $10,000 tax this year, how do we grow our business and grow our wealth overall? And that's where the 3-year thing comes into play. Okay, go for it, Tam.
So better ways to minimize tax. So the goal isn't to pay no tax, it's to control when and how you're paying it. So some smarter ways to be reducing tax is putting some money into super, utilizing FMDs, or for those of you who don't know what they are, farm managed deposits. So if you're a farmer, you can, as Joe said before, we want to smooth out income over years, over those, 3 years. You can actually, if you're having a high profit year this year, go and put money into an account and then pull it out on a low profit year. So farmers have access to that. Utilizing the correct operating structure. So we often see people not being structured correctly. So making sure that you're in that correct operating structure and the best tax environment. Pulling money out of the business. Is it salary? Is it dividends? Is it... Now, the above strategies are going to maximize your flexibility and put a focus on your overall wealth creation instead of just saving tax. So some of those, ones that we told you earlier, what doesn't work very well is, bringing income or pushing income into last year, bringing expenses forward and things like that. That's not going to help with your overall wealth creation. That's just I don't want to pay any tax mindset. These ones here do both. They help lower the tax and they focus on that overall wealth strategy. So what are our top tips? So setting up that tax bank account. So start by setting aside that cash weekly and monthly for future bills. So I always say to people, I'm not sure whether Joe touched on it before because I got picked out, but I always kind of say to be putting aside money at the end of every single week. Add up that, 20 to 30% of the income that you've had come in and push that aside over to that tax bucket. So if you do it weekly, you don't notice it as much from a cash flow point of view as what you do if you try and do it at the end of the month or the end of a quarter. It's a big impact on your cash flow. Little increments make a big difference here. Review your financials. So know where you're at monthly and make sure that it lines up with what's in your tax savings. So, and top that up if you need. So just knowing your numbers and having a really good visibility on what that tax looks like. So speak to your accountant to figure out what that percentage might be for you and your business and your structure. Prioritizing profit. So maximizing profit. And then, as we said before, you're managing and minimizing the tax that comes with that. So real focus on generating that really profitable and sustainable business, as opposed to just going hard, not really understanding our numbers, and then trying to minimize the tax afterwards. So you want to manage that tax. Stop the 30 June panic spending. So as Joe touched on before, don't spend $1 to save 30 cents, and always stay in front of what's coming. So know what your tax looks like, as we said, over that 3-year timeline. So know what it is this year, but what's it going to be looking like next year? Do you need to be talking to your advisor to kind of loop them into what's coming in front of you? Beautiful. So is there any questions since we've gone through all of that? Predominantly Joe. Thanks, Joe.
No probs.
All right, Joe. So there's a question there now. If I'm already
have one
in
come
tax
through there,
debt,
Tam. Question.
Sorry, we're really delayed. All right, I might answer that question just because I don't quite know where we're at. So if I'm already in tax debt, how do I get in front? So this is quite often we have this year that's going to be really, really hard for cash flow when we've got a tax debt and we start to have to prepay next year's. So it's just about really knuckling down and trying to maximize your profit, maximize the cash in the business. So think about things like trying to make sure that your debtors are coming in really quickly, that you're not spending cash silly, that you're managing how much money you're pulling out, and that you're really knuckling down on making as much profit as you can so you can try and get ahead of that. Implement the strategy of trying to just put little amounts away per week so that you're able to start chipping away at it. And it's just about spending that time knuckling down this year to really get on top of it.
I think in addition to that, Tam, it's like any debt really. There's dealing with the past stuff and the liability that you've got to now, because quite often the reality is we do have clients come to us that have been in a position where they have been hit out of nowhere, or the tax bill has come out of nowhere, or they haven't understood it for whatever reason, and they've got a large amount there outstanding that might have just come on because there's been lodgements happen, whether that be BAS or tax. So it's getting an understanding of what that looks like, making sure everything's done and lodged up to date. And from there, we're in a position where we know exactly where we're at then, and we implement the structure that we've already spoken about, the buckets and that sort of thing, so that going forward, that doesn't grow any greater than what it is then. And then we can put some things into place around how we deal with the past stuff. So that might be, as Tam said, maximising and using some of the cash that you're making in order to reduce that down. It might be going to a lender and borrowing some money to crystallise that debt and make sure the ATO is not having a huge amount outstanding now, particularly given that you can't deduct interest on ATO debt. It may well be that you tip some money in personally that you've got available to you. It might be a combination of all those things. But it's I suppose the starting point would be get everything up to speed to begin with before you start, and know where you're sitting. Put the structure in place so it doesn't grow any further, and then put a plan in place to get rid of the old stuff. All right. So we've got a couple other questions here. Okay, one from Brian. What would be the best thing I could do in the next 90 days to get on top of this? Good question, Brian. So there's a couple of things. Our number one thing would be if you haven't got a tax bucket or a bank account, how would you feel if you got to the end of the year and you knew that your tax was covered, or any tax bills that were coming along were covered by what's in that tax bank account? It's a pretty sort of empowering feeling and removes a lot of that noise. So number one would be set up a bank account, work with your accountant to start understanding what that amount needs to be that you're transferring over, and start doing that right now. The next thing would be looking at understanding what your tax bill for this year is going to be, or for the now. And that doesn't matter if you haven't done it up to now. We've got plenty of time. We've got a whole quarter there. I think going forward, you'll be looking at it more regularly. But I would be suggesting you have a look at that and understand, okay, that's what's going to be due more than going forward. And it's got to do both of those things. And I think it's got to meet those two criteria that we spoke about before. It's got to minimize tax and it's got to maximize wealth. So if you're spending money just for the sake of it, then don't do it. It's got to tick both those boxes. So those things we spoke about before, you've got the ability. So using super, looking at your trading structure, perhaps looking at timing of some of the transactions. If you're looking at buying or selling something or entering into a deal, when you do that, that sort of thing, and having a plan between now and then. And then just setting in place a structure whereby you're catching up at least quarterly with your advisor so that you understand exactly what that looks like going forward in the next 12 months, so you can set that up. Okay, so thanks, Brian. Okay, next one, Natasha, thank you for your question. What are FMDs again, and are they for other businesses besides farmers? The answer is yes, Natasha. There are FMD. They're not FMDs, but there are other income averaging provisions that you can use for certain industries. They're quite specialist. So not for most businesses, I would say, but there are other things that you can use. But an FMD is a deposit for a farmer, as Tam said before, a farm management deposit, where effectively when you put money into a bank account, you get a tax deduction, so it reduces your profit in that year. And when you pull it out of that bank account, which is generally going to be more than 12 months after that, you get it's counted as income. Now you don't have there is an upper limit on what that looks like as far as how much you can have in an FMD. Don't ask me what that is off the top of my head because I don't know, but there is an upper limit there. And what it means is that effectively, if you imagine a farmer having a really fantastic year, a really big crop, or a really sensational profit year, and then we know full well that probably in future years there's going to be some more challenging ones. What it allows us to do is take the income in that year, bank it, so it's still cash that's available there, and then ideally access it when you need it. So if you have a year where a crop fails or something occurs, you can pull it back in, and generally speaking, your profit's going to be lower in that year, or you're going to be in a loss position, so you can then bring it back in and spread that income out and flatten it out. Because again, that's something we'd encourage you to think about as well as much as possible, and that's where structuring and things like that come into it as to for what type of structure you're trading in. Tax planning and minimisation is all about trying to keep it as level as possible, because if we're doing this, very, very hard to plan for. So hopefully that answers that question. Thank you, Natasha. Okay. Lisa, thank you. How do I put money aside if I have none to put aside? Great question, because this is something that we often meet when we talk about setting up a tax bucket. It's all good in theory to say, well, you've got to put aside 20% of whatever you're making and put it aside so that you can deal with all future liabilities. That makes, I think most people agree, that makes good sense. The problem with that is that what if it leaves your business in a position where you can't pay your bills, taking that 20%? So effectively what that means is you're relying on that tax money and the money you're going to have to pay later in order to fund your business operating now, which, again, it's obviously not an ideal situation. It can happen at times just through timing. It doesn't mean you've got a poor business or a bad business or anything like that. It just means that the timing's not ideal, and that perhaps there needs to be some things put in place where you can manage that over time. And what I mean by that is quite often when we talk to clients about that and they say, I don't have the ability to move 20% or 15 or whatever the number is we come up with over to that tax account, the next thing we'll start to do is work out, okay, what are your margins? What's your business actually generating? Because if we can't move even say PAYG withholding or GST, which is not, that's not your money. It's not actually included within your profit margin even. It's actually just money you're holding for the government. If you're needing that money all the time, that's an indication and a big red flag that your business is probably got some things in there that you can correct or improve on. And it's not sustainable. So again, if it's a short-term thing and you can plan through it and you know what's going on, it's probably okay. But if you're getting to the end of each quarter and you're having to put a BAS on a payment arrangement every time, and you get to your income tax bill and you haven't got the money there to pay that, and then installment comes and you're always behind the eight ball, it's an indication that there's something not right going on in your business, and there's some things we need to have a look at and change the levels around. And often once we do that, you're in a position where you can, again, set it up for the future, deal with any past problems like I was talking about with Brian's questions before, because quite often if they're past liabilities that are built up, you can't just fix it like that. It is a little bit of having a plan to deal with it and then paying it off over a period of time. But you're also in a position where you're set up going forward, so you're not going to find that. Tam spoke about that before with that client she was talking about, where they've constantly found they were behind the eight ball and they had debt there. They were able to put a plan in place where they caught up, and then now they're in front. Now they understand, okay, yep, we can't spend that money because we've got to put it aside for tax, and they're running their business based on that. Those tax amounts need to be non-negotiable, particularly for the withholding and the GST and that sort of thing. They're not able to be used. And if you're doing that, you're forever going to run into problems. Okay. Another question here from Steph. Thank you. How do I figure out how much tax I should be putting it? Oh, Natasha's asked exactly the same question. Great minds think alike. So how do I figure out how much tax I should be putting away? So there's probably a couple of different ways to do this. But generally speaking, with GST and withholding tax and super, again, that won't be an issue going forward, but it is at the moment. You can get that from your pay run, from your payroll report. So if you think about your withholding tax and you're paying weekly for your team members, what we recommend you do is using your tax bank account. Let's say your net wages, so the amount you're going to pay to the employees is $5,000 for the week. You pay that $5,000, and then you look at the super and the withholding tax that's within that pay run, and you take that out of your bank as well and move it straight over to that tax bucket. It'll tell you exactly what that is. For most businesses, unless there's variable wages in there, that amount will stay the same or pretty similar most weeks or most pay cycles. So you'll be able to work out what that looks like. But while you're paying it, it's just as easy to take it and move it across at that point in time. Again, if your business is not in a position to be able to do that, that's a bigger question. We'd have a look at it then. GST, same thing. Easy to work that out based on your bookkeeping software. It'll give you a report that tells you how much to move. So that's pretty straightforward. And again, if there's issues with that might be a cash flow thing or a profitability thing to have a look at. The income tax one, that's a little bit harder. And what we generally do there is look at what you've paid over the past couple of years, average it out, and then get to what we call a tax base. So we know you're probably going to have an income tax amount at the end of the year of circa, say, 30,000 or 25,000, using the example we gave before. And we'd say, okay, let's divide that by 52 or by 50, and we put aside, whatever amount that is per week, whether that be $500 or $2,000 for the month. or whatever that looks like, so that we're in a position that we've got that money there. We can pay installments. We can pay the lump sum at the end of the year. The short answer is there's no precise exact measurement. You're always going to be a little bit high or a little bit low. Unlike your withholding tax on your wages, it gives you precise and you know exactly what that is. You're going to be a little bit high or low. It's just about smoothing that out and taking that out. So I would suggest we decide on an amount based on prior couple of years. We review. If we're looking at it quarterly, we're going to see how that's going, and we can up it a little bit or drop it a little bit if we need to. And if we can do that, that just means that all the way through the year it's dynamic. There's quite often cases where I get to end of March with a client, and we'll say we're going to vary your June instalment down to a little bit lower amount because you paid enough for the year based on what we've worked out. And if you're working on that all through the year, you can absolutely do that. So it's a little bit of a case of set it based on what it was in prior years and then adjust it on the way through, Natasha. So yeah, overall, you can then get to a point if your business is pretty stable where we can actually, and this is what we do with a lot of clients, once we work out those elements, we just say, well, just transfer $2,000 a week or $3,000 a week. And then we'll adjust it as we need to on the way through because we're looking at it regularly. If you're not looking at it regularly, you can't do that. And you can quite often end up in a position where you put far too much aside or not enough, and we don't want that either. All right. Apologies if you're getting sick of the sound of my voice. You're just getting me this morning, but hopefully that helped, Natasha. Got another question here from Natalie. Thanks, Natalie. Great question. Does that mean you suggest having 4 separate bucket accounts for super, withholding, income tax? My view on this, there's different thoughts on it. I think our overall view at PTP is probably just one bucket is enough. We don't want 20,000 bank accounts if we can help it. Fees, admin, you got to reconcile all those things in your bookkeeping. So one bank account where you're just moving all those amounts into, and you know what you're going to be paying out of there is absolutely fine for 99% of cases. So I would suggest one to keep it simple. Hopefully that answers that question. Okay, I think that's it. I think we've got through all the questions. If there are any other questions or anything you'd like to know in relation to this topic, please feel free to give us a yell. It's the time of year where we're obviously looking at tax planning and that process we were talking about before, and finishing up and just, I suppose, polishing those last bits of the tax strategy that we've come up with clients on the way through. So now's the time to have a look at it. Good time to be thinking about it. If you haven't started something like this, it's a good time to, what do they say? If you haven't started already, the best time to start is now. So start doing it now, start having a look at it, and you'll get a lot more on top of it, and be a lot clearer when you get to the end of the year that you're not going to have that thing that comes out of nowhere and whacks you in the back of the head, as we spoke about at the start. We just had one more question come through from Brian. Thanks, Brian. If we use buckets, can we use an offset account for this where possible? Absolutely. You can. Just be careful about names and the structure you're using. Check with your accountant on that. But absolutely, it can be a really good way to keep cash aside and minimise your interest, particularly with interest rates increasing a little bit, to minimise your interest on loans. It doesn't have to be just a standard bank account. It could be an offset as well. So take that into account as well. I suppose that the number one thing to think about with this tax bucket account is that none of it's yours, right? So it is all going to go in and it's all going to come out at some stage. It's just a means of taking it out of your operating cash flow so you don't use it. So yes, you can use it as an offset. Yes, you can sit it there for a long period of time. You can imagine there, clients that it's not unusual for clients to have, tens or hundreds of thousands of dollars of a tax bill in larger businesses. Now, if you've got that sitting aside in a offset account for 12 months, that can make a huge difference to your interest. So that's what Brian's getting at there. So it's well worth having a think about and considering whether that applies or not. But again, just check with your accountant as to whether it's appropriate for your structure. All right, I think that's it now. we might call it because we've only got 5 minutes left of the time anyway. Thank you so much for joining us. Apologies again for the technical difficulties. That's a real shame that Tam couldn't be more part of that, because I know she does a fantastic job with clients in this space, talking to a number of them over the journey. I think it's the people that her and her team deal with, like there's some fantastic outcomes there, as there is with all people across PTP. So if we can help out with this or anything else, please don't hesitate to reach out. There's our details. You'll probably get some follow-up stuff following on from the webinar. Again, thanks again. Apologies for the technical difficulties, and we'll see you next time.